In recent times, the investment landscape has been challenging. Most major stock indices have seen a year-over-year decline, and the Federal Reserve has been persistently hiking interest rates. However, top-tier investors like Warren Buffett navigate these rough waters expertly, a strategy we'll delve into in this video. For updates on savvy investing tips, make sure to subscribe to our channel. Let's dive in. The Federal Reserve continues to tighten financial conditions. Undeterred by the fallout from the Silicon Valley Bank failure and the turmoil in regional banks, it's crucial to remember that similar spikes in interest rates in the past have led to severe recessions. This tough economic climate is what every investor is grappling with currently, and the outlook remains grim with the Fed signaling further rate hikes. So, what impact do these increasing interest rates have on the economy? Beyond curbing inflation, which is their primary goal, these hikes bring about several significant economic changes, including higher borrowing costs and reduced consumer spending. For investors, this translates into three key effects: falling bond prices, which may increase their appeal, enhanced returns on savings encouraging more saving over spending, and a decline in stock values as they now compete with more attractive, risk-free savings rates. In this environment, how should one invest in 2023? We turn to the timeless wisdom of Warren Buffett, known as the Oracle of Omaha and hailed as the world's most astute investor. Buffett's method for selecting stocks is distilled into three fundamental steps. 1. Seek out companies with robust, lasting competitive advantages or moats, and ensure a thorough understanding of their operations. 2. Invest substantially in these companies when their business economics are sound and the price is right. 3. Commit to holding these investments over the long haul. Buffett's approach, though seemingly straightforward, requires a deep understanding of market dynamics and patience. Apart from the three key steps in Warren Buffett's investment strategy, a crucial element is temperament. Buffett emphasizes that investment opportunities are not just about being smart, but also about staying rational and level-headed. He asserts this point in his 1996 letter to Berkshire Hathaway shareholders, where he advises against owning stocks if a market crash would cause panic selling. He believes that selling high-quality businesses due to frightening news is often a mistake. To illustrate this principle, Buffett recounts the story of Robert Woodruff, the mastermind behind Coca-Cola's success, who owned a significant share in the company. When asked about the right time to sell Coca-Cola stocks, Woodruff simply replied that he had never sold any. This anecdote underscores Buffett's message that the right investment choices, paired with the wrong temperament, can lead to failure. Buffett also highlights what he calls the three philosophical benchmarks for approaching the market: your attitude towards the market, your margin of safety, and viewing stocks as businesses. He believes that a proper mindset towards the market, as described in Chapter 8 of Benjamin Graham's The Intelligent Investor, provides a significant advantage. The principle of a margin of safety offers further security and extends beyond investing. Finally, treating stocks as businesses allows for a different, more grounded perspective than that of many market participants. With these three benchmarks, the specific valuation technique becomes less critical, as they keep you on the right track. For those less inclined to weather the volatility of the market, especially in the tumultuous year of 2023, Buffett recommends passive investment. His top suggestion for passive investment is index funds. Buffett asserts that investing in index funds simply requires faith in America's continued growth and prosperity. This strategy offers a straightforward, less hands-on approach to investing, suitable for individuals seeking a long-term, stable investment path. Warren Buffett, in discussing the merits of long-term investment in American businesses, often refers to his own experiences. He highlights how since buying his first stock in 1942, America has seen a myriad of historical events: 14 presidents, split evenly between Republicans and Democrats, world wars, 9/11s, the Cuban Missile Crisis, and more. Despite these events, he emphasizes the enduring success of American businesses. Buffett notes that the optimal investment strategy, looking back to March 11, 1942, when he made his first stock purchase, would have been to invest in an index fund and then simply disengage from the daily fluctuations of the stock market. This approach is likened to buying a farm and having a tenant farmer manage it. He illustrates this by pointing out that a $10,000 investment in an index fund at that time, with reinvested dividends, would have grown to $51 million. The key belief underpinning this approach is in the continuous progress and resilience of America and its businesses since 1776. By investing in an index fund, you avoid the complexities of selecting individual stocks or timing the market. In his 1996 letter to Berkshire Hathaway shareholders, Buffett advises that for most investors, the best way to own common stocks is via an index fund with minimal fees. He asserts that following this approach is likely to outperform the net results achieved by most investment professionals. Regarding his belief in index funds, Buffett's conviction is strong enough that he even offered this advice to NBA superstar LeBron James. When asked by James for investment tips, Buffett's response was to advocate for investing in index funds for the duration of his career. This guidance reflects Buffett's enduring belief in the simplicity and effectiveness of index funds as a long-term investment strategy for both seasoned investors and those new to the world of investing. Regarding investment strategy, Warren Buffett suggests that beyond maintaining a substantial cash reserve for security, why investing in a low-cost index fund is a wise choice. This approach, according to Buffett, is akin to owning a diversified segment of the American economy over an extended period, typically 30 to 40 years. Such a strategy is likely to see both the value and income of the investment increase over time, presenting little cause for concern. Buffett views investing in index funds as a way to own a broad, diversified slice of America's economy for a long duration. This simplicity and long-term perspective are key aspects of what makes this approach appealing. Beyond offering this advice to LeBron James, Buffett has also been critical of the hedge fund industry. He points out that the fees charged by hedge funds are often disproportionately high compared to their historical performance. This disparity led Buffett to argue that investing in low-fee index funds over time is more profitable than investing in portfolios managed by hedge funds. In 2008, Buffett issued a challenge to demonstrate this belief, betting that an S&P 500 index fund, inclusive of all fees, costs, and expenses, would outperform a selection of hedge funds over a decade. Protege Partners, LLC, a hedge fund firm, accepted this $1 million wager. By the end of 2016, the index fund Buffett chose, Vanguard S&P 500 Admiral Fund, had gained 7.1% per year, amounting to $854,000, while Protege's picks only managed 2% per year, totaling $220,000. Ted Seeds, co-founder of Protege Partners, publicly acknowledged defeat in a Bloomberg op-ed, essentially declaring the bet over and admitting his loss. Buffett's bet serves as concrete evidence that investing in index funds, like the S&P 500, can yield substantial returns over time, often surpassing those of hedge funds. Adopting this investment strategy, particularly through dollar-cost averaging, where a portion of one's income is regularly invested, can lead to significant gains. This method ensures that you're purchasing stocks at varying prices over time, which mitigates the risk associated with poor market timing. For those considering this investment path, it's a matter of patience, regular saving, and consistent investment to see fruitful outcomes.